Hi, I'm Patu from freefincal. Many of us have the incorrect impression that if you take higher risk, we will get higher returns. This is quite wrong, and in fact, taking higher risk essentially could jeopardize the whole thing and could lead to losses or low returns. What you get when you take higher risk is higher risk. Returns may or may not be possible. So I'm going to show you three examples. There are multiple examples. Regular viewers or readers who have seen videos on my strategic indices, you may recognize that just using low volatility stocks, one can beat the market or get a market like return. So it's very counterintuitive, and if you actually go ahead and take or pick only stocks that are more volatile than the market, we'll see what happens with that. So this is an exercise that I would like you to do. Go to value research, go to the fund selector page, go to choose, you can choose all equity funds, and then if you want to select that, go to the returns tab, go to the long term returns, download the data, choose the 3-year returns, then go to the risk stats, get the standard deviation, that is the volatility of monthly returns during that last 3-year period. And if you take the standard deviation, which is a measure of risk, and the 3-year returns, which is obviously a measure of reward, and plot them together, you will get something like this. So notice that, okay, so on the horizontal axis, first of all, you have the standard deviation, which is the risk. The standard deviation is defined in such a way that is always positive. On the vertical axis, you have the last 3-year returns. So in the horizontal axis, as the values go from 5, 10, 15, and so on, the risk is increasing. Notice that initially, when the risk increases, you can see a small increase in returns. Higher the risk, higher the returns. But if you take a little bit more than that, then the returns fall down, and you can actually see you can see returns actually coming down with higher and higher risk. And there is actually one data point. Excuse me. There is actually one data point right here, and there are some data points here which have extremely high risk and negative returns. Typically, there will be sectoral kind of funds typically, and you would be surprised. And I've done this before. I've shown this. Excuse me. If in this risk versus return graph, if you were to plot gold, it will be somewhere here. That's the problem. Gold gives, you take extremely high risk with gold, but the returns are pretty poor. And if you take aggressive hybrid funds, they would be somewhere here. Look at these funds here. There are not in this chart, there are no aggressive hybrid funds, but if you were to plot them, they would be somewhere here. They would offer comparable returns with diversified equity funds, but at a guaranteed lower risk. In fact, if you see these equity funds, I don't know what they are, but if you see some of these equity funds, they have got return comparable to many other funds which take higher risk. These funds here, they have taken higher risk, but they give you a same return as the fund which has taken lower risk. So you can't argue that higher the risk, higher the reward. That logic is completely, it's broken. I mean, one could argue, maybe if this is, I'm comparing within an asset class, one could argue that between let's say fixed income and equity, does higher the risk, higher the reward work? Sometimes yes, but not always. There's no guarantee that taking higher risk will get you higher rewards. This is something that has to be ingrained in us before we start investing. The second example is this nice special index called the Nifty High Beta 50. These are 50 stocks which have a volatility greater than the market, which I assume to be Nifty 100 or Nifty 200 in this case. I forget which is the market, but typically you can expect them to be more volatile or having a beta higher than the Nifty 50. So these are 50 stocks chosen from the top 300 stocks by market capitalization with a volatility greater than the Nifty. For our purposes, we'll assume it to be Nifty. I'll have to go check. I forgot what the exact market is. But the beta has to be greater than 1. It has to be greater than the market. The market, we'll define it as a Nifty. Notice how that's turned out. investing in high beta stocks from 2004 has been extraordinarily risky, and I mean, it has never the even the peak of after the post 2000 in 2010 or 11 there was a peak. That peak has not been reached, and there was a much higher peak just before the 2008 crash. So this is the problem. You just can't assume that you choose stocks which are more volatile than the market. That's a guaranteed way to fail. So this is a basket of 50 stocks which you should not be choosing. So that's how I see it. An anti-index in some sense. That's again another example of why a high risk strategy doesn't work, long term, short term, whatever. Because last you can claim that the last graph I showed was only for 3 years. This is for a much more longer duration. It doesn't work. If you want, I can do this standard deviation versus risk for longer durations and show you. All right, so we will do that maybe tomorrow, maybe in next few days. And the third example I have, probably maybe disturbing to some of you. This is a snapshot from Value Research. This shows the blue line is ICICI Pru Nifty Next 50 Index. The gray line is S&P BSE 100 Total Returns Index. Notice that since somewhere from 2010 onwards, from 2010, for an investor who started investing in 2010, who invested a lump sum in somewhere in 2010, the lump sum investment in BSE 100 would have got higher return than the Nifty Next 50. So you notice that Nifty Next 50 has been a lot more volatile, and it has underperformed for that long a duration. Clearly, Nifty Next 50 is a lot more riskier than BSE 100, a lot more volatile than BSE 100, and that volatility has not paid off in this instance. So that's a problem. Taking on higher risk does not in any way mean you're going to get higher returns. You have to manage the risk actively. I keep saying, then somebody will comment, you are always talking about the problems. What is the solution? I have talked about solutions. You have to look at the asset allocation. You have to vary the asset allocation. I talk about solutions in my Facebook group on goal-based portfolio management. The solutions are there. It's just people don't want to see it. But first, we need to be aware of this simple fact. I'll catch you later. Bye-bye.